Have you guys heard the news? People were acting like the sky is falling. The word came down that Fannie Mae is going to get rid of its credit score requirements for a loan. And people were saying, okay, here we go again. This is 2000. This is the early 2000s all over again. We're lowering credit requirements. All these people who shouldn't be allowed to buy homes are going to get to buy homes. They're going to default and they're going to crash the mortgage market again. Okay, listen, everybody gather round. I'm going to educate you. I want you to understand something. Maybe nobody told you this or you didn't understand it from the movie The Big Short, but I'm going to walk you through this. I need you to understand, first and foremost, most government insured backed loans at their core in the underwriting requirements, they never had credit score requirements like your FHAs and VAs. They don't have credit score requirements. They have debt to income ratio requirements. They have reserve requirements, but they typically didn't have credit score requirements. So you say, well, Mark, but when I went to go get my loan, I needed a certain credit score. Yes, that is true. And why is that true? Because of something called an underwriting overlay. Each individual lender who lends money hopes to give you a mortgage, bundle all of its mortgages together, and sell those mortgages on the market on Wall Street. And so to do that, those packages of mortgages have to meet certain guidelines and requirements. So even if FHA or VA didn't have a credit score requirement, the buyer of bundles of mortgages do have credit score requirements because they get grouped in tranches. So people who have 700 plus credit scores are A paper, and then you have B paper, C paper, all the way down to people that got super high interest loans with 580 scores. Those people are in a different tranche, and that paper sells for less money than the A paper. That's how that works. And so there's still going to be an overlay that lenders do. So what Wells Fargo may require, that Bank of America has a different requirement, that Chase Bank has a different requirement, that Capital One has a different requirement, and all the hundreds of lenders that are out there, they put an overlay in their underwriting to say, this is what we will take. These are the loans that we will take in because these are the loans that we can sell. And so you are still going to have underwriting scrutinized because the general rule of banking is if they can't sell it, they won't buy it. So they're not going to lend you the money. They're not going to give you the mortgage if they can't sell it on Wall Street. So you don't have to worry about that. The other thing is that this is a good time to talk about the fact that I'm seeing this all day. People are saying, yeah, this is what crashed the market, and people defaulting on loans when they did and stuff. That's not what crashed the market. That is absolutely positively not what crashed the market. What crashed the market was the securitization of mortgages, that grouping together of mortgages in tranches, right? And selling them bundling and selling them on Wall Street. It's called securitization. And then the derivatives, which is basically insurance that you put around those tranches, where the insurance policy gets triggered if there's more than, I believe, like a 3 to 5% default rate. So we were taking every mortgage that existed in the country, and it was becoming three financial products. It was the mortgage itself, it was the bundle of loans that it was in, it was the tranche of loans that it was in, and it was the insurance on that bundle of loans. Whenever the default rates got high on any of those places, it would trigger a default, not just of that loan, it would trigger a default of the tranche because too many loans in that particular tranche went bad. And then the insurance would kick in, and it caused absolute mayhem and disaster. But if those loans had not been securitized, and think about it for a second, Okay, the default rate, the default and all of that triggering happened when the default rate went above 3%, right? Okay. Well, if you lent 100 people money and 3 of them defaulted, right? So you lent 100 people money for mortgages. 3 people defaulted. You would simply take those 3 houses back through the foreclosure process and then sell those houses to someone else, right? Not a big old deal. However, if those 100 houses were part of 3 different securitized instruments and payouts had to come from all of those things just because 3 mortgages went bad, it causes absolute financial disaster. It is securitization. It is the financial games being played on Wall Street that really was the issue. You could always resolve simple defaults by taking property back and selling it to somebody else. That's why all of those houses ultimately got reabsorbed. You know, does anybody ever read an article about a bunch of foreclosed homes that nobody is buying? No, we see that the demand is so high, we don't have enough homes to buy, and the price of housing keeps going up. So don't be fooled by the story. We're always in this country, we're always victimizing people and then trying to blame them and say that, oh, it was all these people who got houses that shouldn't have gotten houses that crashed the financial markets. They had no opportunity to do that. They didn't even understand what they were a participant in. The reality is that making all of these mortgages into financial products, and if those financial products end up going bad because they have trigger and default rates, that is what absolutely crushed the market in 2008. All of that going bad. If you don't believe me, you know, if you want to see an illustration of it, go watch the movie The Big Short. That's what those guys are talking about. That's what they're taking bets against, because somebody realized, oh my God, if this goes bad, this is going to get triggered, and then this will get triggered, and this will get triggered. If I bet against any of this stuff going bad and the default rate going above 3 to 5%, I'm going to make a fortune. And that's what happened. So don't try to now make Fannie Mae and dropping the credit score requirement part of this narrative and bring back this totally phony narrative that they came up with in 2008 and 2009. It wasn't true then. It's not true now. Okay. At the end of the day, regardless of what Fannie Mae, FHA, VA, regardless of what their requirement is, every single lender is going to put their underwriting overlay over what they will put mortgages out at. And most of them are going to have a credit score requirement, and it's going to be the only way that they're going to take your loan in. And so, you know, the sky is not falling, nothing crazy is happening, and everything is going to be okay. The biggest issue in the housing market and in the mortgage market is affordability at this point. Houses are just out of control, and as interest rates come down, and if this 50-year mortgage gets instituted, you know, you're going to see housing prices really go up. So affordability is the biggest issue that really confronts the market and what have you. But it's not this Fannie Mae thing is a non-issue. Okay, so you know, those are my thoughts. This is just Mark Fuller, manager of Wealth, giving you my thoughts on this change in the underwriting guidelines, and it's no big deal. So thank you so much for listening. If you need me, just reach out. Take care.